Citadel, Citadel, Citadel. We all know them from the legendary GME saga, but now they're shorting the treasury bond market through the repo market. This is going to become a legendary financial tale that one could dub the mother of all margin calls. This is part 2 of the repo market scandal, so grab your popcorn and let's do this. We are Stonk News Network, the central information source for the retail investor. I'm your host, Bill Steele, and today we're going to continue unpacking the second half of the repo market scandal, which according to our research team, is a melting pot of what could become the worst financial crisis in global financial history. Today, we are going to break down a bit about the repo market, Citadel's involvement, Palafox, BlackRock, and what the FICC and DTCC have to do with everything. There are chapters below to help guide you. I sense your smooth-brained alpha waves from here. What is a repo market, you ask? Well, we have another video coming out soon on our latest channel, Stonk U, to go into more depth about the repo market. But for now, this is what you need to know. A repurchase agreement, or repo, is a short-term secured loan. One party sells securities to another and agrees to repurchase those securities later at a higher price. The securities serve as collateral. The difference between the securities' initial price and their repurchase price is the interest paid on the loan, known as the repo rate. The repo market is an obscure but important part of the financial system that has lately been drawing an increasing amount of attention. On average, 2 to 4 trillion in repurchase agreements or collateralized short-term loans are traded every day. And as we said before, Citadel is shorting the treasury bond through the repo market. Citadel owns the company Palafox Trading, whose sole purpose is to short and trade U.S. Treasury securities. Palafox manages the Citadel Global Fixed Income Master Fund, Ltd. They have total assets over $123 billion and are 80% owned by offshore investors in the Cayman Islands. Their reverse repo agreements are entirely rehypothecated. If you want to know more about rehypothecation, click the card above. As I was saying, this means that Citadel cannot pay off their own repo agreements until someone pays them first. The entire global financial economy is modeled after a fractional reserve system that is beginning to experience the premature rumblings to the mother of all margin calls. Remember our 801 bombing video? Well, this current repo market situation is a major contributing reason as to why the DTCC and FICC are requiring an increase in their supplemental liquidity deposits. The madness has officially come full circle. Hedge funds and banks move money back and forth to have liquidity. Banks like to buy stocks or lend cash, and if banks need to have cash, they set up a repurchase agreement. Think of this as a quick loan that lasts a few days to get a nice chunk of cash, and then you repay them with a little bit of added interest. That is what a repo is. We keep hearing about the 10-year treasury rate going up, and this has caused a lot of panic, and stonks have been selling off as of lately due to this panic. That's just a little snippet of the situation. The cause of the '08 crash was the movement of the shitty mortgage-backed securities, which were a big part of most repos. Fast forward to 2021, the US Treasuries make up a significant portion of repos, up to 67% of all of them. So when the US Treasuries are used as collateral in the repo market, and the price for those treasuries shoots up, this can set a nice climate for a big margin call. Now, to dig further into the Citadel-owned company Palafox, I'm sending you a galaxy away to my co-host, Bidma Sharif.
Thanks, Bill. Let's dig into Palafox Trading Company deeper. They serve as a market maker for repurchase agreements. Repo market makers provide liquidity to the market and keep things flowing. Think of them as the market plumbers. The spooky part about Palafox Trading is that they are owned by Citadel. Citadel has their own private repo market. They don't have to use other banks to make repo deals. They just roll everything into the Citadel Global Fixed Income Master Fund. How convenient. They have total assets over 123 billion, and 80% are owned by offshore investors in the Cayman Islands. Now let's roll back to 2008, when everyone realized that the mortgage-backed securities were worthless. As a result of that, the repo rate spiked. Now we are in an opposite situation. The Fed has printed a lot of money, and add that to the fact that there is a significant volume of treasuries. The demand of these securities should result in a higher repo rate. But since March of last year, we are looking at a short-term repo rate of almost zero. The 10-year treasury price is coming down as of recently, and its yield percentage is going up. Sounds a lot like what has occurred with GameStop. Citadel and friends are trying to short the treasury when they actually need to get their slimy hands on them. Now, guess who they are going to? That's right, BlackRock. By the way, BlackRock is part of the Fed's ploy to buy bonds and keep interest rates low. BlackRock is a key player in Citadel's shorting scheme, and they use Palafox to turn this into cash. In theory, this should work out all fine and dandy. But what happens if they have shorted more treasuries than actually exist? Just like GameStop. Well, now the potential for a gamma squeeze exists. This past year, the repo rate has inverted into the negative on 3 occasions. This sets up an odd scenario where instead of paying someone to borrow from them, you are paying someone to borrow for you. What the absolute? This is why it's a parallel to GameStop. It's like a pawn shop paying you to take their money. And they say they will keep paying you to just hold this loan. So in exchange for a treasury bond, cash is being given with added interest for the purchase of the bond. That is some cockamamie, contorted, backwards financial market shit. There is a desperation to find bonds, and if BlackRock doesn't keep getting more treasuries, where will Citadel buy from? Palafox's statement of financial condition shows they have liabilities which are 31 billion plus in gross repo agreements. Do they have enough assets to buy those back? They don't. Why? Because our piece of financial system allows for unchecked rehypothecation. That's a big fancy word for using amounts owed to you as collateral for another transaction. In the event that the other party defaults, so do you. This means that the securities which Palafox is waiting to receive have already been pledged to pay off the bonds they currently owe to someone else. Does that sound familiar? Promising to repay something with something you don't already have. Basically, you need to wait on Ted to repay Steve, to repay Jan, to repay Mark, to repay you. So you can repay Fred, so Fred can, yeah, real secure. To unpack and close out, I'm spinning you beauties back to Bill.
Thanks, Bidmash. Now I'd like to turn our attention to the FICC, which stands for Fixed Income Clearing Corporation. They're a part of the DTCC, the Depository Trust and Clearing Corp. Both of these are central security depositories that are designed to ensure securities transactions are completed in a proper manner. They have over $45 billion in deposits for unsettled treasury bonds, which can't be sent back to them due to them being shorted into absolute oblivion. So if all went according to the hedgie's plan, in this case, BlackRock, Citadel, and company, the price of bonds should go down and they'll all get paid. But if no one is selling the treasuries and instead holds, we end up with a situation much like GameStop. If everyone holding these bonds decided not to sell, then much like GameStop, those in the position of holding short contracts can never cover their losses. The outcome is theoretically infinite for the buying back of said losses. The same exact concept that happened with GameStop again applies to the treasuries. If you can't get your hands on any treasuries, the DTCC and FICC understand the absurdity of the unchecked rehypothecation circus that is going on, and they want to pump the brakes on this clown fiesta. They're trying to do this by telling these funds that they can't just live off of leverage. They need to keep more dry powder on hand and be prepared to be checked by said DTCC and FICC organizations. Cue the 801 bomb. By the way, a little outro note. Ben Berkenine is an advisor to Citadel, and for those of us who prefer crayons to food, he used to run the Fed and is amply capable to provide information on how to continue the orchestration creatively of this entire show. That's all from us here at SNN. If you like this video, be sure to check out more of our other videos and channels. It is our goal to arm you with the financial literacy necessary to take on the machine. I'm your host, Bill Steele, and if you want real financial news in real time, be sure to subscribe to Stonk News Network, where we pour jet fuel on the retail investor revolution daily.